This is going to be all about the US online lending industry. We have some leading experts here. We've all heard from Renaud already today. But I wanted to kick it off just with a quick introduction. If you could introduce yourself and tell the crowd why you are here in Europe.
All right, my name is Renaud.
You need a microphone.
Microphone, thank you. So I'm Renaud Laplanche. I'm the founder and CEO of Upgrade. Why am I here? I know you invited me. But I think more, there's a rationale for it. I think the marketplace lending industry in the US is becoming more global, not so much in terms of the borrowers. So US platforms are still very much focused on US consumers, US small businesses. I think the flow of capital is now coming partially from Asia. That's what drew me to LendIt China, and partially from Europe as well. So we're seeing a globalization of the appeal of US marketplace lending for global investors.
Okay. Karen?
Morning, I'm Karen Mills. I ran the Small Business Administration and was part of President Obama's cabinet for 5 years, starting in the middle of the recession. So I became, before that I was a venture capitalist, and I'm here because in the process of running the SBA, I became quite interested in the importance of small business to the economy, the importance of access to capital to small business because it was frozen, and what technology was going to do to change the game. Writing a book on it now, and I'm here not only to be part of this, but I've been spending a lot of time with the UK government on what they've done differently than the US in their regulatory structure and what we can learn from them.
My name is Meg Zwick. I am Director of Client Services with Millennium Trust Company, and we are here to listen and learn and expand the ability to support our clients that are looking to use us for custody services.
Hi, how are you? I'm Peter Rahbar, founder and CEO of DVO1. I'm just honored to be on the stage with all these marketplace legends, so I couldn't turn down the invite.
Okay. So I want to kick it off. Like Renaud, in your presentation earlier today, you gave a picture of how sort of the online lending space has evolved. But I want to sort of dig in a little bit just in a more narrower time span and see. We had our challenges in the US in 2016. 2017, it looks like it's a better year. But I just want to if you could give perspective on how in the last 12 months, what has changed in the US online lending industry?
So I think the industry has continued to be very dynamic. So you're at a couple of platforms sort of stopped growing at the pace we were growing before. I think there's been some amount of retooling and a lot of learnings in terms of compliance, of risk management, a couple of credit hypotheses that didn't turn out to be right. So some segment of the consumer population didn't perform as well as the platforms thought they would. But despite all that, I think it's been sort of some growing pains. But despite all that, I mean, the growth rate has still been pretty impressive, even in 2016 for the entire industry. And more importantly, I think the industry continues to be sort of more helpful to more people. And a lot of the retooling that happened last year, I think is bearing fruit this year with better model, better compliance systems in place, better data integrity, and I think renewed confidence from investors and optimism from the platform. And you see now a lot of new investors getting into the space, mostly because new loan buyers, mostly because because of the factors I just mentioned, but also with, I think, structured investments in a way that works for these investors. So the large, more conservative sort of insurance companies, banks, pension funds can now access the product through the securitization market. We can take a senior position in the product, either public or private securitization. We have now pass-through securities that is enabling sort of loan buyers who don't want to deal with loan accounting to essentially buy securities, buy a QSIP securities from an investment bank. So I think the industry is maturing. I think what was really interesting also in 2017 and late 16 was the sort of entry into the market of Goldman Sachs with the Marcus platform and the launch of Upgrade. It was a major event.
Indeed it was, yes. So maybe let's I want to kick on with the securitization piece. Maybe, Perry, I know that you're heavily involved in that market, and it throughout where we had a bit of a downturn in 2016, but securitization kept on going strongly. Is that simply because, as Renaud said, that there's new investors coming in and able to be more comfortable with the asset class, or what is behind, in your opinion, the continued growth of securitization in the US?
Yeah, I think probably the biggest factor is just that all the originators kind of took control of their own destiny in terms of securitization and became issuers and started their own shelves. So some of the first deals that we saw were, investment banks buying loans from the different originators and then doing the deals themselves, and I think that was something that didn't work out too well. And so we've seen, at this point, pretty much every major originator, whether it's Lending Club came to the market, Prosper created their own shelf, Marlette, Avant. SoFi has always been doing it this way, and I think they've all kind of adopted this model, and what it's done is it's not only allowed them to contribute loans themselves to securitization, but it's provided liquidity channels for loan buyers. So, and they're active issuers, and the market's gotten comfortable with them. The deals are pretty much, everyone knows what they're buying at this point, and now going into the fourth quarter, see deals from Lending Club this quarter, Prosper, Marlette, Common Bond, Avant, all of them coming, and this is probably their third or fourth deal of the year.
Right. Okay, I want to switch to small business lending, and Karen, maybe you could give us your perspective about, we've heard from a lot of banks starting online lending platforms. There's clearly a lot more volume and a lot more of capital available to entrepreneurs. So have we started to solve this problem, that access to capital for entrepreneurs?
Well, the small business market is really diverging from where the consumer market is going in the US. And there are 4 phases, and we are sort of at the end of phase 2, the beginning of phase 3 in small business. Phase 1 was the Wild West, and Renaud was there at LendIt. I think Larry Summers stood up and he said, 70% of small business loans are going to go through these platforms. That's not happening. And what's happened after the Wild West was that the banks woke up and, the dinosaurs said, wait a minute, we've actually got some assets here. And they began to do some of the things you heard on the last panel. They began to walk around and talk to the innovators, invite them in, create. And surprising to us, we thought it would go to partnerships. We thought phase 2 was bank fintech partnerships. It turns out that a much greater percent in the US than I would have expected are building their own. And the reason is the small business product is not innovated very much. It's the customer experience where the innovation took place. That poor small business customer trudging from bank to bank, waiting 3 months for a no answer with a stack of paperwork. And they figured out with relatively little investment and disruption and innovation that they can build a better front end, tack on a more automated version of their own credit process, and, surprise, surprise, look into the accounts of their customers and know a lot. So the 20% penetration initially on, the new online lenders is sort of, I think, calmed down, and the banks are rising. Phase 3, we'll talk about some more, I'm sure, is the platforms. And I think that's where the action is going to be for small business lending. Just taking a page out of Alibaba, out of Amazon's lending. They're already connected. Square is already connected to the small business world. And phase 4 is what I like to call small business utopia, where all the small businesses get access to the capital they need to grow and thrive.
Yeah, we're not quite there yet.
Not quite there yet.
So, okay, we'll talk a bit more about that in a bit. But Meg, I want to turn to you and talk about the investor mix, because I know you work with a number of different investors who, for many, many years, who are accessing this asset class. Some of them are coming in for the first time. What kind of investors are you seeing? How has the mix changed over the last year or two?
It's been interesting. Initially, when we started supporting this industry, we were supporting small hedge funds, 150 million average assets, and we've seen that taper off. And the level is now an interest of the higher level institutions, clearing firms, larger investment management firms, creating 40 Act funds. And I think the direction here is that there is a drive to make this asset class more accessible to the non-accredited investor, where they're not necessarily in a position where they have to pick their own loans, but have access to this market through a fund that provides that access.
So you're here in London, obviously. Are you seeing more international investors coming in with interest?
It's interesting. We definitely have some international investors, but I wouldn't say that that's been a primary driver of the growth of our business over the last year.
Okay. So, Renaud, I want to turn back to you and talk about Goldman Sachs. I mean, you mentioned them in your presentation. You mentioned them just now. There's a lot of people who I think we had a similar panel to this last year, and the general consensus is that Goldman Sachs wouldn't do a very good job. And I think that has proven wrong. I think they have, they're growing pretty fast. They have a great customer experience, and I think they're continuing to do well. So how's a company like Upgrade, who you're newer than Goldman Sachs into this space now in some ways? How are you competing with them?
We're not. So I think we have different target markets. We are focusing on different segments of the customer base. I think Marcus by Goldman Sachs is rightfully focusing on sort of prime and super prime segments. But I think I have more synergies with other Goldman Sachs businesses, but also sort of fits their own sort of risk appetite. And we're focusing more on the lower prime and near prime segment. And that explains a lot of what we're doing in terms of credit monitoring, credit education, and really helping consumers better manage their finances, make better credit decisions. So it's a different segment. But I think in general, let's talk about so how other platforms might want to compete. So I think that a lot of the sort of industry commentary on Goldman Sachs has been, hey, Goldman Sachs is going to have a really good competitive advantage because we have more stable funding and lower cost of capital than the pure play platforms, which isn't necessarily right. So first, I think there are two parts of the cost of credit. There's the cost of capital and the cost of operations. And so traditionally, Goldman Sachs, they have a lot of very smart people. They're really good at what they do, but they are not known for their low cost of operations. No. So I think that one goes on the camp of the pure play sort of technology-enabled platforms. Now, as to the cost of capital, I think that's the very essence of a marketplace lender, is to have access to a very wide range of cost of capital. So Goldman has their own cost of capital, but a lot of the platforms sell loans to banks, So they essentially borrow or benefit from the cost of capital of whoever is buying the loan. And so when you have credit unions now buying loans from marketplaces, the credit union in the US has often a return on asset target that is in the 2 to 3% range. It's actually lower than Goldman Sachs' return on asset target. And now, I think, just to take the Lending Club example, there's about 40% of the loans that get bought out by banks. So I think in the part of the credit spectrum where it matters, which is, again, prime and super prime, where you really want to drive down the cost of capital, I think the platforms, the marketplace lenders have access to a similar cost of capital as Goldman Sachs. But they also have more diversity in that capital, and they can access other pockets of capital that are sort of less price sensitive, and where the cost of credit, where the cost of capital isn't that big a factor.
Mm-hmm. Okay, so maybe, Perry, can you give your perspective on that? I feel like you're talking to many different platforms that are all in some ways either competing directly against Goldman Sachs or not, but they're also competing against each other. What is the competitive landscape like? We've seen, some new entrants, well-financed new entrants coming in. We've seen the incumbent marketplace lending platforms, have struggled. So what are your thoughts on the competitive landscape in the US?
Yeah, it's tough to tell exactly how competitive everyone is with them because no one has seen their loans.
Right.
We have market data on everyone but them. So I think Renaud would probably be in the best position to know just going after borrowers where, they're having success and where they're not. And, where they're not, there's always probably a bank balance sheet with a lower cost of funds operating. I definitely agree with Renaud in the makeup of those two components between the operating cost and the cost of capital. I do think the difference is that their lower cost of capital, although like in great moments like this, everyone might have access to that kind of effective cost of capital. It's when the not so great moments, how much more sustainable and durable their business is. Maybe they could just, they could be around a little bit longer, whereas we've seen this kind of, the marketplace model definitely has some bumps in the road. But I think one thing that we're seeing is that, across from all the different platforms, even though the securitization programs have picked up, as they've kind of rebooted and supply is picking back up, they're really diversifying their capital base a lot as well. Not just selling to loan buyers who might be contributing to securitizations, but actively going after real pockets of money, whether it's insurance companies and so forth, that are going to be purely buying this and holding it. And then the other thing I would say is it's a massive market, and we haven't even really scratched the surface, right? There could be $1 trillion of this, and we're talking about, we've seen less than 100 billion. There's a lot more opportunity. So I think there's enough room in the sandbox for everyone to kind of play, especially as they carve out their own little niches.
Right.
Yeah, actually, if I can react to that, in terms of the sustainability or durability of sort of Goldman Sachs' source of capital in an economic downturn, it feels solid, right? It feels big.
Does,
it feels like it's always going to be there. It wasn't in 2008, and you had sort of Warren Buffett bailing them out. So a downturn is coming. Would you rather have exposure to one single investment bank or hundreds of credit unions and community banks that are going to continue to get deposits from their members and are going to continue to want to do something with these deposits?
Yeah, that's a fair point. So I want to move from one giant to others. We've had talked about, and Karen, you just touched on this. So I'd want to talk about the Amazons and Google, Facebook, Apple. Some of these companies are already in the small business lending space. Amazon have been lending to small businesses for some time. Google has as well. We've got other like PayPal have a small business lending operation. These companies are giant, and if they wanted to divert enough resources into small business lending, won't they just dominate the market? I'd love to hear your thoughts, Karen.
Yes, I think they are going to dominate the market, and that is the next phase that's coming. And the question is, in what form, with what kind of products? And there's a second question, under what regulatory authority? But if you just think about the kinds of things we've heard here about the artificial intelligence, the use of data, and you think about the advantages the banks have been taking by looking into their customer base, imagine that you know a lot about a small business customer because you manage their inventory if you're Amazon, because you see how their sales are. And then imagine that you know everything about the person that's buying that small business's products. And you can share with them, you know, right before they bought your product, they bought X, or they did Y, or they traveled to Z geography. You've got an enormous set of information that you can use to the advantage of your small business customer. So the trick now, from where we are to there, is to see what is the product that they are going to deliver to these small business customers. Put yourself in the shoes of a small business owner. They need capital for a whole set of reasons. Some of it, half of it is really just about cash flow stability. They have no cash buffer. And they need lines of credit and just cash availability to take the bumps out of the road. Well, if you have a pretty good view about what bumps are coming, then you are better able to provide that capital. So that goes for the JP Morgans, the Barclays, and the Amazons of the world. If you really know their customer well and you can help them grow, you know, that's another really important product that you can deliver to small businesses. So I think creating the product experience, creating a product that is a good fit for a small business customer, the right customer product fit, and then perhaps a service component of that goes beyond just the loan. You could see platforms having a tremendous advantage in that category. So I think they are potentially the winners. And if you talk to folks here, you say, who are you most worried about? Those are the names that come up.
Yeah, it's crazy when if you start thinking about it, Karen. I was just, as you were talking, realizing how much data they actually have, like Amazon especially. I mean, they could be a data, like they could have a whole data business providing intelligence to the small business owners because they know so much about their customers, and it's fascinating. So just on that though, I mean, where do you think, you know, you've been in Washington, you know how these things work. What are the regulators going to do about letting, you know, the Amazons and you know, and Apples and Googles of the world?
I thought you were going to ask me what is happening in Washington, and I was going to say, yeah,
we're not going to go
there. What is happening in Washington? A year ago, when we had this conversation, we put out a regulatory agenda for financial services reform right before the election, right after the election, and we felt pretty confident that, particularly in a Trump administration, you know, this was more likely to be taken on, and because the banks are feeling burdens from Dodd-Frank, things would go along and get fixed. Well, in the last year, none of that has happened, and as you know, it is unlikely, given the backlog of healthcare, tax reform, and other things facing Congress, that they will get to financial services reform. So that leaves it in the hands of the regulators to do by rulemaking. And the answer there is we have what I call spaghetti soup. We have 7 regulators all overlapping. And to change, and so now they're having a big fight. The question is, does the OCC actually have the authority to grant all these charters? And if not, who does? What risks does it provide? So I think this is a slow process. I would have said a year ago it was going to get done. I would say now it is likely to be some time and some controversy before any of this actually gets done. And by the way, the tech companies, you know, are on the beginning, you know, are just about over the cliff. They are in the free fall in the sort of Washington political environment and not beloved as of a couple weeks ago. And I think that everybody expects that trend to get worse, not better. So I think that will not likely happen soon, but it will happen eventually. So these political times will pass, and I think one could expect, either by state authorizations or by other kinds of activities or by different regulators coming in or different decisions being made, that people will enter this market and have authorization.
Right. Right, so I want to switch gears a little bit and just talk a bit about the investor environment here. I mean, we heard yesterday from the various public funds that are operating here in the UK. Many of them are actually US companies, and we haven't had, I mean, the regulatory environment has resulted in the fact that there isn't, well, there has been 40 Act funds, there is no publicly traded, open-ended mutual fund that you can invest in. And so, Meg, I wanted to get your perspective about why are we further down, are we closer to getting these easy investment vehicles that the public can invest in in a publicly traded fund that's on the stock market? Are we getting closer, or are we still just as far away as ever?
Well, I think we're closer than we've ever been, right? And the 40 Act funds that launched in 2016 have been very successful. But I think that there's still some regulatory overhang that they're trying to work through in terms of truly becoming an open-ended listed fund that's publicly available. To me, what I see as a primary challenge is just liquidity and being able to satisfy redemptions on a daily basis. So while I think we're definitely closer, I wouldn't be surprised if we're still a few years away from that hitting the U.S. market. Right,
right. So I feel like we can't have this panel about the U.S. without talking about Equifax. We all know about what happened there, and maybe, Renaud, you could give us your perspective on the impact you think it might have on online lending. I mean, are we going to have consumers freezing their credit, and then they're going to be less open to taking out loans, or is there a deeper issue that you think it's going to impact?
Well, I think security in general is a massive issue, and I think the recent history has shown that everybody can get hit at any time, and there's no sort of bulletproof defense. So we're all doing the best we can in terms of security, but it's a matter of if, not when. Right. It's a matter of when, not if, you get hit. But I think there are best practices in terms of how to respond to a security breach, and obviously telling your customers right away and not waiting for 2 months is a better idea. Right. So in terms of how that impacts the space directly, I think we've seen an increase in number of credit lock or credit freeze. Mm-hmm. So that creates a little bit of friction in the process, right? So when your credit is locked in the US, you essentially, the lenders can't pull a credit report unless you give a specific authorization to let that particular lender pull the credit report. So it's a 2-step process with a phone call. I think some of the credit bureaus, including Equifax, are trying to come up with a solution that makes that process easier and makes it online and automated. But at this point, it does create a little bit of friction. It adds a couple of phone calls, but it's not a super big deal.
Okay. So we're running out of time here. I wanted to open it up to the audience. Does anybody have a question for our esteemed panel? Oh, we got one down here. Just wait for the mic runner. Where do we have the microphones?
Hi, this is Stefano Valeri from Aragras. I've got a question for Karen. Has there been talks in DC to mandate some type of capital requirements for the Google and the PayPal of the situation? Thanks.
So I'll repeat the question just to make sure. Are there talks in Washington about capital requirements for Google and or others? Well, the debate right now is whether the OCC has the authority to actually allow them to have a non-bank license. And if they are given some kind of license, then the question comes up, you know, is it a bank license? Is it a non-bank license? And this all has not been litigated yet. So the big fight was with the Fintechs in the beginning. And I'm on record, we wrote a white paper a year ago that said we thought there should be a non-bank license, that the innovators were good for the industry, and I think the head of the OCC at that time put a very good proposal together saying, you know, we can do this with safety and security and manage it separately, not as a bank. The banking community went crazy, which you can expect them to do if Google shows up, and as they did with Walmart and others. And they're very powerful in the US. The community bankers organization is powerful, and then the big bank organizations are powerful. And they pretty much have shut that down. So I would expect, as this gets litigated, whether it's on the table today or not, there would be some kind of either capital requirement or requirement to register under some of the banking laws, because banking light is definitely not viewed by the competition as appropriate for the new entrants.
Mm-hmm. Anybody else? Yep. Down the front.
Thank you. In the last couple of weeks, the Bank of England and the FCA have issued warnings about rising consumer debt in the UK economy. And this, of course, comes against the backdrop of anxiety around Brexit. I'm wondering, given the model in the US, and Renaud, you addressed this earlier, I mean, that model, the consumer online lending model there, is predicated so much on refining credit card debt. I just wonder if there's any consumer groups or there's any voices in the US that are expressing concern about over-leveraged consumers in the US market and what impact that might have on online lending volume growth.
Yeah, so the US consumer today is actually less levered than it's ever been. I think the sort of debt servicing ratio is now at about 10%, just under 10%. So it's since that ratio has been tracked, it's the lowest reading. If you look at the financial obligation ratio, that's a better measure because it does include sort of rent and utility payments that are not captured in the debt servicing ratio. You still have sort of very sort of historically low level of financial obligations. I think the US consumer is doing fine from that standpoint. In terms of the impact of online lending, yeah, to your point, it's been a lot of refinancing of existing debt at a lower interest rate. So I think we are helping the US consumer delever, or at least lower the cost of existing debt, not just in personal loans used to refinance credit cards, but also for sort of student loan refinancing that's been used to lower the cost of education lending.
I just wanted to add something on student loans. The one thing that has come up is that the level of student debt in the US is of concern. And an interesting niche business, just offering this idea up, is employers are starting to think about taking on the student loans and repaying student loans of applicants in order to get the best and the most talented, particularly tech workers. Now, it's not a big market, but you could see employers taking on some kind of, there could be a product which employers could buy which could either consolidate or take down or refinance student debt to give them a much lower rate. So imagine, you know, you're lending to XYZ company at their cost of capital with their guarantee instead of to the student at their guarantee. You can arbitrage a bunch of the cost out to the benefit of the employee.
Mm-hmm. Mm-hmm. Before we go, I want to get this one more question into Perry, that because we've got a lot of investors at this event, and I'm sure people will be interested in your perspective, Perry, about, you know, there was some weakness in late 2015, 2016. We saw a pullback from many investors. I'd like to get your sense when you're looking at the data on the actual loan performance from these platforms. How is it trending in 2017, say, compared to 2016 and late 2015?
Yeah, it's definitely better. There's not a ton of data on 2017 loans yet, but one of the things that we do is we just track like Q4 2015 versus Q4 2016, which is where I think there was definitely a reboot for a lot of people. And performance is definitely better across the board. I mean, we just track where things are 10 months out on a loan age adjusted basis. You could see it better anywhere from 60 to, in some cases with some originators that have really done a little bit of a turnaround, 100 basis points. Better at this point in time from a return standpoint. That doesn't mean that terminally it's going to be a lot better. There could still be some shocks downstream, but when you want to talk about just underwriting, you see a lot of that stuff manifest early on. And so I do think, to Renaud's point, there's definitely been a maturation amongst all the originators and really fine-tuning their underwriting models, and that's kind of what they've said all along, right? It's a very iterative process for them, and we've definitely seen that getting better now. I guess the bigger question is, that's also been in that vintage, there was very low volume, right? So, that was definitely probably some of the better borrowers that are out there are available at the time. So now that we're seeing volumes pick back up to where we kind of were, it will be interesting to see how these loans perform downstream. Mm-hmm. But it's been a very controlled growth, I would say.
Right, and so maybe we should finish off with looking forward to 2018. I know, Renaud, you made 3 predictions in your presentation. I don't want to go back and revisit them, but maybe we can talk about sort of the overall health of the industry. Are you feeling like we have a better, a more robust industry now? In 2018, are we going to see, more consolidation, more companies going out of business, newer things happening? What's your thoughts on the coming 12 months?
Yeah, so I think 2016 has really been an important year in online lending. It was the end of the first 10 years and the beginning of the following 10 years. And I think as I said in my presentation, I think the growth is going to accelerate from there. The industry is going to continue to be more mainstream. I think 2016 was a good opportunity, again, to retool and sort of fix some short-term tactical issues, but also sort of longer-term sort of deploy new infrastructure, particularly for the new market entrants, and take advantage of new technology that helps and will continue to help the industry operate at a lower cost, which again will deliver a lower rate to consumers and businesses. And I think we'll see a lot of product innovation. I think the phase 1 was essentially sort of relaunching the personal loan product that had been around before. That was a household finance. That was the way consumers in the US were financed before credit cards came around. So it wasn't a true innovation. It was like repackaging an old product, but making it a lot more efficient and convenient. I think we'll see now, based on new technology platform, based on all the learnings of the last 10 years, I think we'll see true product innovation that is going to deliver more value to consumers, will make credit more available, more affordable, and more convenient for consumers and small businesses.
Okay, well, on that note, we're out of time. We'll have to leave it there, but thank you very much, everybody, for the panel today.
Thank you.
Thank you.